Hi, if you're new to this channel, my name is Greg Hardy, and this channel revolves around basic day-to-day personal finance topics and tips that will lead you to financial freedom. So what if I told you there's a way to grow your money without lifting a finger? It's not a get-rich-quick scheme, but it is one of the most powerful ways to build your wealth over time, and it's called dividend reinvestment. Are you curious how that works? Well, stick around. This video could change the way you think about investing. Dividend reinvestment is like planting a tree that grows more branches every year. Now, what I mean by that is when companies pay dividends, they reward their shareholders with a portion of their profits. But instead of cashing out those dividends, what if you reinvested them to buy even more shares? Over time, those new shares earn their own dividends, creating a snowball effect. So that's what we're going to discuss in this video, is the power of dividend reinvestment and how it can drastically change your financial future. But before we get started, if you're into growing your wealth and making smarter financial decisions, I ask that you hit that like button and also subscribe to this channel. It really helps this channel to grow and it gets this info out to more people. Now let's get started. View dividends like a thank you gift from a company to its investors. When a company makes a profit, it can choose to share some of that money with its shareholders. These payments are called dividends. Think of it this way: for companies to reward you for believing in them and for owning a piece of their business. Not every company pays dividends, but many of them do, especially those that are well established and make steady profits. Dividends can be paid out in cash or sometimes as extra shares of stock. Companies usually send these payments out every quarter, though some do it once a year or even monthly. The cool part, if you reinvest these dividends, you can buy more shares, which can lead to more dividends in the future. Dividend reinvestment is a simple but powerful way to grow your investments over time. Instead of taking the dividends as cash, you can have them automatically used to buy more shares of that same stock. This process is often done through a dividend reinvestment plan, also known as DRIP, where your brokerage or the company that handles everything for you. No extra work is needed. Here's how it works. Let's say you own shares in a company that pays quarterly dividends. When those dividends hit your account, instead of sitting as cash, they're used to purchase more shares or even fractions of shares. Over time, those new shares earn their own dividends, which are also then reinvested. It's like a snowball rolling downhill. Your investment keeps growing faster the longer it's in motion. DRIPs make it super easy for investors to grow their money automatically. With the DRIP, any dividends that you earn are used to buy more shares of the same stock, without you having to do a thing. Many companies and brokerages offer these plans, and some even let you buy shares with no extra fees or even at a discount. The best part about DRIPs is how hands-off they are. Instead of worrying about what to do with your dividends, they're reinvested for you right away. Even if your dividends aren't enough to buy a full share, DRIPs allow you to purchase fractional shares, so every penny gets put to work. Over time, this automatic reinvestment can build up your wealth and help you take full advantage of the magic of compounding. Compound growth is what makes dividend reinvestment so powerful. When you reinvest your dividends, you're not just earning money from your original investment, but you're also earning dividends on the new shares that you bought with the previous dividends. This creates a cycle where each year your investment grows a little more, and so do your dividends. The longer you stick with it, the bigger the impact becomes. For example, in the first year, your dividends might only buy you a small amount of extra shares. But as time goes on, those new shares earn their own dividends, which buys you even more shares. It's like planting seeds that grow into trees, which then produce more seeds. The snowball effect can turn a small investment today into something much bigger down the road. One of the primary reasons to consider automatic dividend reinvestment is to harness the power of compounding interest. For instance, if an investor who placed $10,000 in an S&P 500 index fund in 1960 would see their investment grow to over $640,000 by the end of 22, based solely on price appreciation without considering dividends. However, if they had reinvested those dividends, their total would exceed $4 million by the end of the same period. This illustrates how significantly dividends can impact long-term returns. Not all stocks are great for dividend reinvestment, so it's important to focus on companies that consistently pay dividends. Some of the best options come from sectors that are known for stability, like utilities, consumer staples, and healthcare. These industries tend to do well even when the economy slows down, making their dividend payments more reliable. You'll also want to look for companies called dividend aristocrats or dividend kings. These are businesses that have not only paid dividends for many years, but have increased their payouts every year for decades. Think of companies like Coca-Cola, Procter & Gamble, or Johnson & Johnson. These stocks may not grow as fast as others, but their steady dividends make them perfect for long-term reinvestment and compounding growth. While dividend reinvestment works best with reliable companies, it's essential not to put all your eggs in one basket. Diversifying across multiple sectors like tech, healthcare, and utilities helps spread risk. You could also consider dividend-focused ETFs or mutual funds that automatically invest in a wide range of dividend-paying companies. This way, even if one company reduces or even eliminates its dividend, the impact on your portfolio will be smaller, keeping your wealth-building strategy on track. Some great options include the Vanguard Dividend Appreciation ETF, VIG, which focuses on companies with a history of increasing dividends over time, and the Schwab U.S. Dividend Equity ETF, SCHD, known for its low expense ratio and exposure to high-yield U.S. stocks across various industries. The iShares Select Dividend ETF, DVY, targets companies with higher than average yields, providing exposure to sectors like utilities and energy. Another option is the SPDR S&P Dividend ETF, SDY, which invests in firms that have raised their dividends every year for at least 20 years, ensuring stability and consistent growth. Finally, the Invesco Dividend Achievers ETF, PFM, focuses on companies with a strong track record of dividend growth across multiple sectors. These ETFs make it easy to stay diversified, so even if one company reduces or eliminates its dividend, your overall investment strategy will still stay on track. Dividend reinvestment is all about patience. It's definitely not a quick way to get rich, but it works wonders over the long haul. The key is giving your investment enough time to grow through the power of compounding. In the early years, the growth might seem slow because you're only earning small dividends. But as you keep reinvesting, those small amounts will start to add up, and your investment grows faster and faster. The longer you stay invested, the bigger the results. Over 10, 20, or even 30 years, those reinvested dividends can turn a modest investment into a much larger one. With patience and consistency, dividend reinvestment can help you build real wealth for the future. While dividend reinvestment can be a great way to grow wealth, it's not without its risks. One thing to watch out for is dividend cuts. Companies aren't required to pay dividends, and if they run into financial trouble, they might reduce or stop paying them altogether. This can slow down your investment growth and affect your overall returns. Market downturns are another risk. If the stock price drops, your reinvested dividends might buy you more shares, but the value of your total investment could take a hit in the short term. It's important to remember that dividend reinvestment works best over many years, so short-term ups and downs are just a part of the process. Staying patient and picking solid companies with strong track records can help you manage these risks and keep your investments on track. One of the underrated benefits of dividend investing is how it cushions your portfolio during tough economic times. Even when stock prices drop, companies that consistently pay dividends can offer some stability. Instead of relying solely on the ups and downs of the share prices, those dividend payments provide a passive income stream. Reinvesting those dividends during a downturn also allows you to buy shares at lower prices, which can boost your potential returns when the market rebounds. Some real-world examples of this includes AT&T. In 2022, they reduced their dividend from 52 cents to just under 28 cents per share as part of its efforts to manage debt and invest in growth areas. Also, in early 2023, Paramount Global cut its quarterly dividends from 24 cents to 5 cents per share due to financial pressures. Have you ever invested in a company that has cut its dividends? How did that affect your investment strategy? Starting a dividend reinvestment strategy is easier than you might think. First, open a brokerage account that offers dividend reinvestment plans. There are several great investment companies that you can choose from, but the most popular are Vanguard, Schwab, and Fidelity. Look for stocks or ETFs that pay reliable dividends, ideally from stable companies with a history of consistent payouts. Once you buy shares, enable the DRIP option through your brokerage, so dividends are automatically reinvestment to buy more shares. After that, just let the process run its course. Be patient, stay consistent, and review your investments occasionally to ensure that they align with your financial goals. Over time, those reinvested dividends will compound and grow your wealth. By understanding how dividends work and the benefits of reinvesting them, you can set yourself on a path toward financial growth without needing to make constant, active decisions. The key is patience and consistency, allowing the power of compounding to work in your favor. While dividend reinvestment is great for growing your portfolio, there may be times when taking dividends as cash makes sense. For instance, if you're close to retirement or you need the extra income to cover your living expenses, you might choose to stop reinvesting and take the dividends as income. The key is to align your dividend strategy with your financial goals. Early on, reinvesting makes sense to grow your wealth, but later in life, you may want to enjoy the fruits of your investments. Remember, while there are risks to consider, staying focused on quality investments and a long-term strategy can lead to significant financial rewards. Embrace this approach, and over time you'll likely see your investments blossom into substantial assets that support your journey towards financial freedom. Feel free to share in the comments how dividend investing has affected your wealth and what your experiences has been with them. If you want to learn more about growing your wealth, then check out this video right here. But before you do that, don't forget to like and subscribe. Thank y'all so much for watching. I really hope you liked this video and that you got something out of it. I'll see you in the next one.